building a firm, you need to think about core activities in terms of investing, fundraising, and then operations, and make the decision early. How are you going to set that up? In terms of just basically coming down to roles, who's doing what, but also those activities are completely not the same. Good investors may not be good operators. Good investors sometimes are not the best money managers, so not the best fund manager. I think those are all considerations that could help you build a firm that lasts a long time.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Jeroen van Doornik with us. Jeroen is the founder and managing partner at Pacenotes, where they're investing in top tier VC funds and doubling down on breakout companies. In this episode, we talk about how to build a VC firm that stands the test of time, what separates emerging firms from brand name firms, the challenges faced by limited partners, most crucial metrics for VC firms to track, leading deals versus co-investing alongside other leads. What's a better strategy for VCs? Reserve versus no reserve. What's a better approach? Solo GPs versus multiple GPs. What do LPs prefer? And so much more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast10X, where I help VCs start and run their own podcast. While I was running VC10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Jeroen, so good to have you on the VC10X podcast. How you doing?
Thanks for having me. I'm great. How are you today?
I'm doing very well as well. To start things off, can we first start with your story and why you started Pace Notes?
Sure. Yeah. So my background has been in venture. Having started out in consulting, doing strategy projects, and founded a company actually a long time ago. I have since then, let's say since 2010, I've been, almost 15 years, been quite active in launching various funds. The last one I was a managing partner of was a fund for a Dutch system bank of 250 million, where we basically were also investing in other funds and doing direct. So we were backing managers already since 2018, more or less. That's where I basically come from, and to me, in venture, the power law is we can discuss it in more detail, but for me, ventures is the power law is important. It's a real thing, so to say, and the other is that there's generational differences, I think, between the US and Europe. I think the US is ahead in generations and experience in venture. At the moment, it's Europe is quite far away still from having a stable and available institutional investor base for venture capital. I mean, for the asset class in general as a whole, it's getting a lot better. There's a lot of initiatives, like recently, Nico Rosberg's new fund has been launched. So there's a lot going on, but still there's also a big opportunity, and that actually leads me to to the launch of Pacenotes. Is that's where we want to be as an investment management firm. We want to be part of this ecosystem and be the stable institutional capital for managers. We're based out of the Netherlands, but we focus on Europe and US, and we basically have two products. So we invest in outlier venture funds and also direct. And so far that strategy has worked since we built it before for the Dutch system bank. It's been working for us, and that's actually going forward where we want to be in the venture ecosystem to support Europe, and get there's a lot of catching up to do, so to speak.
Right, totally. So Pacenotes is a fund of funds, right?
Yeah, we do both. So we do the typical co-investments, as they call it, and direct and into funds. So we're not typical in the sense that you have your seed and emerging fund of funds, and then you have your multi-stage fund of funds. What we do is we back managers that have been here for a while, so they're experienced. They have track record, so to say. But we do not, let's say, back 15 or 20 plus managers, because we're not as diversified as other funds may be. We're more focused, so we have a bit more of a conviction strategy with our fund of funds program.
Right, totally. And you mentioned about the power law, and we know how it plays out inside a VC fund, wherein it's like 80% of the investments you make will not work out, 20% of them will return your fund, right? So that's how it works out there. But in a fund of funds model, how does that power law play out? Because I think the risk is lower in fund of funds to lose the entire thing altogether, right? So tell us more how the mechanics work for fund of funds.
Yeah, I think there's some statistics in the market. At a certain point, you add a new fund, and it's actually only diversifying the portfolio, but also limiting upside. If you look at the whole landscape, I think everybody knows that that seed funds, pre-seed funds, and can get like true outlier performance, and the later stage funds can have great performance, but it's completely at a different level in terms of multiples. We're sort of in the middle. So we built a portfolio where we have indirectly exposure to, let's say, 300 companies, maybe 300 plus. Then on top of that, we invest directly in a couple of companies within the portfolio. So there you can truly see the mix. We're skewed towards early stage. So also there you can expect a little bit higher performance, but still quite diversified in our portfolio construction. So it's a mix of, as we call it, getting access to venture returns, but not necessarily the true risk that can be attached to like a pre-seed or seed stage company or strategy even. So that's where we sit. Yeah.
Yeah, totally. And tell us more about the strategy of investing into venture funds, but also investing in the outliers that are maybe the portfolio companies that are working out really well for these VC funds, right? So, how does that strategy bring you more closer to VC scale returns, being a fund of funds while minimizing the risk of losing it all?
Yeah, so I think what we look for in the direct investments, they of course they need to be good investments in itself, but we want to the direct investments to have another, well, basically a different profile than a fund, right? So you're expecting a lot more from the direct investments. We typically invest around Series B, depending what's what, and typically in series investing, A, B, C. But anyways, it's around Series B, and those sort of companies typically have a higher profile than, let's say, a growth stage fund, right? You're expecting a lot more. What we do is we never lead round, but we are very selective in sort of our approach to co-investing, in the sense that we source our own deals. Typically, we invest in fintech or in any large market that we understand. Our background is in fintech, so that's what we understand. But it could also be insurtech or legal tech, anything that has more or less the same dynamics going on in the market. Large market that's going through a digitization. That's what we look for. And being and one of the reasons, we're looking basically for an additional layer of performance for the funds that we back. So we're not going to invest in 15 plus companies, because then it would become like a direct investment fund in itself, right? So it's next to the main vehicle. It's quite a bit different approach than we usually have. But it allows us to be super selective, because, as I said, if you're looking at 300 plus indirect portfolio companies, I wouldn't say there's a lot of time, but we do have, of course, a good basket basically to be able to try and cherry pick out of that portfolio, because we can track companies. We do follow the top 10%, so to say. There's enough or more shots on goal than you would typically have with the direct investment fund, where it's just a little bit more difficult to have so many opportunities basically.
Right.
If you're tracking, like, again, top 10%, then that fits our strategy, and it tends to give us good access to where we want to access the companies as well.
Right, totally. And that's also provides an additional benefit to your portfolio VC funds that if they manage to get an outlier in, then they also have a potential growth investor in you who can directly come in and invest in those companies and further support those companies.
Yes, and there I think speed is critical. So what we've seen over the years, most of the LPs ask for co-investment rights, but it's important to be able to make the decision quickly, to be part of a round. And that's a bit differentiated from other firms, I'd say, given our background that we come out of direct investing. I think we have a good understanding, and we can sort of follow the timing of a GP.
Right, totally. And when you're looking at the VC funds, you're evaluating these funds. How do you make the decision whether to deploy in them or not? What are the key factors that you're looking for in them?
Yeah, I think there's what we call like the usual items that everybody's looking at, like, for example, track record. It's not necessarily, in our point of view, a proxy for the next fund, but it does give you an idea of the consistency of a firm, right? So it does give you a sort of a proxy for the quality of the manager if everything else stays the same, like portfolio construction. What we do is we dive deep on the networks of the people that we work with. We focus on their ability to win deals, right? And that oftentimes comes down to them having some sort of a founder experience, operator experience, being able to level with what basically a founder is going through. That's important. The other is, again, besides all the usual items, I think portfolio construction is something that we spend a lot of time on. GPs here can really make a difference in showcasing their experience. I think some GPs are really good at showcasing experience and how you set up your portfolio and portfolio construction, and what learnings that they have over the years. And then another is what we're focusing on quite a lot. What we're focusing on is decision making. For example, the market's been quite hot. Decision making around liquidity, exits, creating DPI. It's for us. It's really interesting to dive into that and see how the dynamics were and what decisions were made by the partnership. And it also tells you something about the experience and what the manager is basically focused on in the portfolio. So those sort of items are really important, but I think like other LPs, everybody's doing their homework. But for us, networks and portfolio construction and decision making is quite critical.
Right, totally. So you work with a lot of emerging managers at Pacenotes. So what would be your advice based on what you've seen within your portfolio and also other emerging managers on how to build a firm that can actually stand the test of time, and it's not a one-off fund that you raise a fund and then
Yeah.
okay, that's done. That's it. That's the story, right? So how do you build this
Yeah.
firm that actually stands the test of time?
Yeah, and it's we don't invest in emerging managers. We do work well. We do get a lot of questions, and in our network there are a lot of emerging managers, and we do try to help them because every firm at some point was an emerging manager. So and it's good for the ecosystem. But with our fund, we typically invest in the brand name firms, and there's quite a lot of learnings because the question there's an infinite amount of scenarios almost coming towards a new manager, right? So it's how do you build something that lasts the test of time? It's quite a challenge. I think what's good for emerging managers is to consider what type of firm they want to be, and be, of course, in terms of positioning in the market, you need to be quite clear about your messaging, where you sit in the ecosystem and everything. But simultaneously, you also need to be flexible, because over time you'll probably shape and craft a narrative, and maybe even your focus and strategy a little bit. Like, for example, some firms, or I think there's quite a lot of firms actually globally that started out in as accelerator programs, right, and then became seed stage funds, for example. So there is a sort of a point in time where you may want to change your strategy. So that's on the, let's say, the front end. Decide what sort of firm you want to be, but do keep, let's say, the 20% open to change in future. And then the other is building a firm. You need to think about core activities in terms of investing, fundraising, and then operations, and make the decision early. How are you going to set that up? Is it in terms of just basically coming down to roles, who's doing what, but also those activities are completely not the same. Good investors may not be good operators. Good investors sometimes are not the best money managers, so not the best fund manager. I think those are all considerations that could help you build a firm that lasts a long time. And also another is maybe LP composition. So from day one, the firm going forward, the firm probably will reflect the LP composition a little bit. You can imagine, a large institutional is looking for a different setup than the typical maybe high net worth individual is. So take that into account in how you build your firm. I think that's good. It's oftentimes, I think, also overlooked a little bit for emerging managers. So they want to get from A to B, but point B looks different, and it's not currently built into the fund. So maybe it's just better to do A all the time. But those sort of things are important, but you need to be flexible because venture is dynamic. So you need to have that opening to be able to be flexible and change things along the way.
Right, totally. And you mentioned you're investing in brand name funds, right? So how do you differentiate investing into brand name funds versus investing into emerging managers? Because there's some narrative out there that maybe investing into emerging managers can give you more outsized returns as compared to brand name funds, because some brand name funds, not all, are not driving those kind of returns that are expected out of them. So what's your perspective on that?
It's all about the sort of the risk reward you're after, right? So to my last point, I think there's some emerging managers that are really great at investing, but the firm may not always last. There's also partner politics, and if you look at sort of graduation ratios from form 1 to 2 to 3 and everything, it doesn't look that good. So you need to be lucky, or you need to be really an expert, as some firms are, right, in this space. For us, it's a decision about where you sit basically in the ecosystem, right? It's that's critical to where we sit. Emerging managers with smaller funds, can have a really great performance, but what's the horizon? You're getting a different product, so to speak, with the managers that have been around for a long time. And there may be that's also outside of our folks, because some firms are really have a really strong brand, or have become they've become too big for our strategy, because at some size it just becomes difficult to create what we call venture returns, right? But it's still a good product in that sense, if that fits your strategy. So it depends on the LP or what you're looking for. But as an offset, I think more emerging can be more riskier depending how you approach it. With higher returns, and brand name firms may have a more institutional setup that fits the needs of an LP, and that's how we approach it. And I think probably making the distinction between what's what is also the challenge for LPs. It's not straightforward,
Right.
in that sense, right? A new manager on fund one is it's clear to see, they are emerging, but maybe post fund 3, 4, 5, 6, it's not always clear for LPs, I think. So being able to make the selection is also it's very important.
Right, totally. So most of the funds you are investing in, so at what fund are they operating at, if we talk about some general average, right? So is it like fund 3, fund 4, or it's like even beyond that?
Yeah.
Okay.
No, it's post fund 3. Yeah. So typically, typically that's the setup. On average, it's a bit higher, I'd say. Yeah.
Right. So, and what makes a brand name fund a brand name fund? Because is it all down to luck that, okay, if an emerging manager finds an amazing company that returns their portfolio, they are now termed as a successful firm, whereas another emerging manager didn't end up finding that one, maybe unicorn startup or something that could return their fund. They are not such a good manager and will potentially not raise a fund 2 or fund 3, right? So where is that line drawn, where an emerging manager crosses that line from being an emerging manager to being a brand name fund?
Yeah, I think being able to repeat portfolios and consistency is probably one of that, right? So I think a lot of, let's say, the outlier or the best VC for funds in the world have been uh, outlier funds, and also maybe the sort of one-off type of firms that you mentioned, because they've only run a couple of funds and that's it, and they were super successful. I think if you're allocating, and that can be a strategy in itself. You're really optimistic. You have like outlier performance with any strategy that you're running. But I think if you're allocating institutional capital, or you're more institutionalized yourself as a firm, it's you're looking for that consistency. And for us, it's about strategy aligning with operations, and I've mentioned that in other podcasts as well before. It's critical that those things align, right? It's let's say if you want to do a global um, seed fund, it can be hard with two people, just as a random example. But I think you need to align that. So your strategy and portfolio construction needs to be super clear, but then your organization needs to match that. And I think at some, when funds start, after some time, they probably are shaping the firm a little bit as well. And at some stage, some get there, some don't. But I think most, and that's probably the inflection point where somebody could, changes from an emerging manager to let's say a brand name. And the other is, I think you're right that there's also a lot of investors, of course, that still claim to have done deals, right? And I think it's normal because there's a lot of club deals and co-investments going on. It can help for a brand of a firm, right, to have done a great deal. But you probably, as a firm, want to be in a position to lead rounds and have a strong brand name amongst the founder audience, right? Which may be a different audience than we are now discussing. That that your brand is maybe as a sort of an outsider perspective, but and a little bit as an insider, but that could be a different group where you want to be known as a great firm.
Right. Yes, totally. Yeah, there are two aspects to it. One, you can stand out by providing outperforming returns in your portfolio. That's one way in which you can stand out to LPs. And the other way is, of course, like you mentioned, that you have a brand name, a literal brand name, right, in the market, that and founders know about you. The deals come to you, right? Even if you've not been lucky enough to
Yeah.
find a great deal, but you still see good deals. You have good access. So that can also
Yeah.
impact the success of the firm, right?
Oh, for sure. Yeah, yeah. And I think again, if you discuss emerging managers, former operators, founders, they tend to have this access, right? So they're well positioned to build great firms or great funds.
Right.
And firms is to be seen, but yeah, I think that's true.
Yeah.
I mean, in the end, it's all about the founders, right? So if you work with great founders and you're in the ecosystem, in the networks of the people, then your starting point is quite good.
Totally. And one of these two things is completely in your control. The other one's slightly dependent on luck, right? Awesome.
Yeah.
And now let's talk about what are the key challenges that LPs face when deploying into VC funds.
Yeah, I think I already mentioned one, but some of the key challenges are, I think, let's say, especially for new LPs, it's just the basic finding relevant funds, and then if you walk through the, sourcing, access, picking, and winning, it's the same for an LP. Having the coverage, seeing like the most relevant funds, finding them, then being able to select them, and then create access, right? So because it's not every fund, with the minimum tickets and everything, you need to be able to access them as well. And then maybe one level deeper, I think it's from also more sophisticated LPs or more experienced LPs. It's looking beyond firm level. In the end, as I said, it comes down it's all about the founders. And I think a GP needs to convince a founder to work with them. Having an understanding of that, on that level beyond the firm, I don't think a lot of LPs are looking at that sort of level of detail, but we think it's really important. Um, and then another layer maybe is one of the challenges is understanding the portfolio construction. What is a good construction, and then maybe the last one is just comes down to having and maybe also experience, but having an understanding of cash flows, of managing the liquidity, understanding the J curve. Of course, any experienced LP will know this, but it can be challenging even for the new, maybe for LPs that have a little bit of experience. It can be challenging to understand the different flows and dynamics of the market, and it's hard to time exits and distributions and so forth. So that can also be a challenge, right, in the portfolio mix. I mean, again, for anybody that has experience, it's easier, but yeah, it's part of the challenge. From basically access to the front end to the back end, there's a couple challenges that you need to take on.
Right, totally. And you mentioned how liquidity is important, and that's why it's being said how DPI is the king, right? So, from all the different metrics we have in the VC spectrum, which one do you think is the most important? Like, if it's DPI, then why so? And what are the other metrics that are crucial for LP deployments?
Interesting question. Yeah, I think DPI is of course important, but returns in general is important. But I think it's also a bit standardized for what a seed stage fund is looking for, and a growth fund is looking for, and so on. For us, again, this is part of the standard items that we look for. I'd say that maybe even the capability to lead deals and win deals, which is not a metric, and as we are discussing it, is even more important, if you see what I mean, than just the basic numbers, right? I mean, any GP is super ambitious, I'd say, and historically, I think LPs have an understanding of what strategy leads should lead to what sort of outcome. But you know, betting on the managers that they're capable of finding access and winning the right deals and leading them. I think it's for us we're skewed towards early stage, so it's that's still important to us. And then on metrics, yeah, DPI is nice, but for example, valuations specifically in the, let's say, the first couple of years of a fund, to us they don't it's good if they they don't mean as much, right? So because it's so therefore DPI is of course a good one, but on the other hand, on average it's quite late in the lifetime of a fund where
Right,
there's significant DPI. So
right.
again, back to being able to lead deals, finding access, having the right strategy, and then we'll look at how the fund develops over time. So
Right.
yeah, hard to pick one specific metric, but yeah,
Right.
again, we like firms that are positioned and are capable of winning deals.
Right. Absolutely. And from a perspective of an LP, so the VCs that are leading deals, right, that are acting as leads in the deals they're participating in, versus the VCs that simply have a tag along strategy, that we are just going to tag along other leads in the deals, and we are going to maybe depend on them for some due diligence, and because they are more recognized in the industry or whatever reason. Which one of these two types provide better returns for LPs?
Oh, that's a good, interesting question. Yeah, I think I don't have the data at hand, but I think being in the position to lead deals means you are in the position to get interesting ownership stakes, right? And typically in venture, again, we discussed very briefly power law, but having a significant ownership or a stake in a company that's doing well is critical to get interesting returns. Um, so that's the strategy that works, and it's important, at least from sort of the outset, to be able to create, as we call it, venture returns. But on the other hand, specific sort of co-investment strategy also works, right? So it's just that your strategy is different. You may not be able to set the terms and may not get the same ownership stake, but if you're set up for just more or less executing those type of deals, Yeah, I think again, I don't have the data now, but I think it has also, if you would walk through the data, it has also worked. I think again, if you go back to the strategy and operations point, and that the fact that in a firm it's best if they are completely aligned or aligned out. I think that's the key challenge, right? Like you do not want to lead, have a firm that should lead and then is not able to. Basically, I think that's where probably the performance differences come from.
Right, right. Totally, totally. And talking about the success of the portfolio, right? So, how do you track the success of the portfolio and what are the key metrics there? Because, like you said, DPI comes in later in the picture, right? So, early on in the fund cycle, what are the things that you're tracking to see how things are moving on the portfolio front?
Yeah. Yeah, I think especially in a seed fund, for example, it could take years and years, right, to get to some significant, interesting performance numbers. I think so for us, it's a matter of winning deals again, and getting the ownership target. It's an indication of, is the GP or the manager in the position to execute their strategy? Are they getting what they were after? It's For us, maybe it's 50, no, it's not 50-50, but it's more important especially in the early days of a fund cycle than focusing on the numbers alone, because again, especially in seed stage or in even early stage, in any fund it will take a long time. So as long as they are winning the deals, they're getting the stake that they're after, within the fund's focus, of course, and all those sort of things, I think we're happy. But and also, depending on market cycle, but you just know that eventually it will take some time, to get to an interesting, at least on paper, performance level. And it's also a matter of where the market is, right? So if it's super hot, like we've seen in the last years, then things can go quickly. But usually, statistically, if you look at all the data, it's not as quick. So you
Right.
just, you know, besides the quantitative stuff, it's this sort of metrics that we look for.
Right. Yeah, totally. It's not initially. It's not that much about the numbers as much it is about how if the manager is able to execute on the strategy that they promised to implement. Right. So that's the deal there. Right.
Exactly.
Awesome. And there are firms. I think most firms these days have a reserve strategy. Right. Some sort of reserve strategy, and there's few firms that don't have a reserve strategy at all. Right. Uh, do you think having a reserve strategy helps? If yes, then how much of a reserve percentage should be kept in a fund? If there's any advice on that.
Yeah. Um, I don't know. I think if you do the math, then we did the math on this. Then with hindsight, everything is easy with hindsight. I think, yes, these firms who had reserve were able to execute the reserve, would have been like way more successful, right? So it's clear that's, for us at least, that from our point of view, that makes sense. I think again, if you look at your firm setup, you need to be in the position to be able to, execute, the reserve. So it's probably good to have reserves, but I can also imagine if you're like a micro seed stage fund, or just in general seed stage fund, and um, that and maybe you just want to get all the equity stake that you can get upfront, and then work with SPVs, or having an opportunity vehicle with your LPs, if that works for you, if it's efficient, to execute that. So having a reserve probably, yeah, it makes sense to back companies that are winners. Again, it's power law, but it should fit into your strategy and operations. But if you do the math with hindsight, yeah, again, it's I think for a lot of firms, it's, let's say it's interesting to do that, and it does make sense. Yeah,
Right.
uh, yeah. But if you're small, then, if you have a small fund, and it's not efficient, I can imagine there's other ways to do this.
Right. Totally. And another aspect of VC firms is that whether they have one single GP, that those are solo GPs these days, and the other is, of course, having multiple partners. Right. Most brand name funds, of course, have multiple partners, but some emerging managers just run the shop entirely by themselves. Right. So What's your perspective on this? Having an individual GP or having multiple partners? Which one do you think is poised for success?
It's interesting because it probably also has to do with decision making. Now it comes to mind also on reserves, right? Because they're aligning a strategy and operations. It's also going to take time and energy of the partnership to make the decision, depending how you set it up. Anyway, so yeah, solo versus multiple partner. What's a better choice? That's the question, right? It's
Yeah.
I think partner politics is a real thing, right? So in the dynamic of a VC firm, you're introducing partner politics. If you have multiple partners, it can work. But I think I'd lean to in this option of being option I've been given, solo versus multiple. I'd lean to solo GP, as I think the efficiency of a firm does not necessarily increase with adding more partners. Outcomes or impact could be higher, but not necessarily maybe the efficiency of the firm itself. So the dynamics internally, um, given that venture is mostly about being a great, picker, or having the great access and being a great picker. I'd go with solo versus multiple partners in the firm.
Yeah, I think I've seen that firsthand. So I run a podcasting firm wherein I help VCs start their own podcast, right? It's called Podcast 10X. And I work with different types of VCs there, right? And there are some solo GPs that I work with, and there are some firms with multiple GPs, right? So what I've seen is that the solo GPs are much easier to work with, and they are much quicker in decision making, while the ones with multiple GPs take a lot more time in getting back to you and making those decisions. And I think this would be very much reflected on the investing front as well for them. Uh, and I think speed is a crucial aspect when you are trying to win deals and win competitive deals, right? So I think
Yeah.
that's where having those multiple partners, if you're not super efficient, can backfire.
Yes, and sometimes it does. And on the other hand, these multiple partners can bring more to the table. So again, it's depending a little bit on your strategy and stage. But I think there is a lot, especially let's say in seed, or there's a lot to say for or pre-seed solo GP funds. Again, yeah, because I think you're rightly mentioned. The speed of decision making, finding access. Um, in general, firm when it becomes bigger, it's just a bit slower and has more
Right.
activities that are not focused on investing.
Right. And another key aspect of this is that firms with multiple partners have multiple partners for the reason of being able to increase their AUM and increase their fund sizes, so that the funds that are being managed per partner is sensible enough for the LPs to deploy. Because sometimes the LPs see that what's the per partner, how much of the funds are being managed, right? So in that case, if a firm is trying to increase their AUM or raise a big fund, right, maybe 200 300 million fund, they would probably bring on a new partner and to justify having that additional capital to deploy. What's your perspective on that?
Yeah, I think it can be a reflection of sort of LP demand or opportunity that's there. I think we prefer if it's optimized for multiple and not for ARM. Having that fund size, discipline, and strategy, it's probably a challenge with firms that have that discipline. They're always doing this more or less the same thing. Partnership sticks together. They tend to have really strong performance. But I can, so that's why we again, that's what we prefer. That's what we focus on. But I can see that it's tempting to dive, jump onto different opportunities and facilitate maybe LPs, hiring new partners. It's a different strategy, but I think the correlation with size and performance, they go in opposite direction, right? So it's what you're looking for. If you start out as a funky example as a seed fund and you're building $1 billion seed fund, then at some point it becomes really difficult to get to the performance that fits the stage where you're investing in. So, but yeah, also here I think it's just experience of a manager and the decision, but it could also be driven a little bit by the partnership. Let's say if you have a generational cycle, or that could impact this sort of decision making. It's not many firms have the same side, are in the position as well to just keep executing that. I think that's also one of the factors. There's factors outside of your control, basically, that are steering or leading this sort of decision making as well. But yeah, again, optimizing for multiple is probably for us it's better, but in general, it's a good strategy.
Right, totally. I think like about this discussion that I think it's the relationship between partners is as crucial as the relationship between co-founders if you're talking about a startup, right? If that breaks out, things can really go wrong, right? So do you have anything to, if you're investing in a firm that has multiple partners, to assess the relationship between the partners that are there, and how far back does that relationship go back?
It can go quite far back. I think, given that we come from direct investing, usually we work with the managers on a deal or a couple deals, or we sit on boards with them. So we get the perspective of their core business, right? So we work together on the core business. So I think that gives us sort of a unique perspective on what's happening. I think founders have a good understanding of what VCs and individual partners bring to the table. So that's also, in doing due diligence and everything, you can build a good perspective on the firm. I know there's some firms that are using specific programs for this, but it's always a bet on the people. So yeah, many LPs do a lot of reference calls, and that's a good way of trying to assess how the partnership works. For us, it's been really good to just have done a direct investment together, to see how the firm operates, how the decision making, as we just briefly discussed, works, governance, portfolio management, and everything attached to it. Yeah.
Totally. And now coming to my last main question before we do the rapid fire round, and this is, what do most emerging managers get wrong, or take time to realize while they're in venture capital?
I think that it's not all about investing. Maybe that's something that is sort of overlooked when they start out. It is, right, but you have to manage a fund, and all the activities that are part of fund managing. From investing, fundraising, and operations. It's maybe if you have a seed stage fund and you just start in the beginning, it's not as relevant. But soon enough, I think, when you've done your first quarterlies and everything in the terms of reporting, and you're building your firm, I think, yeah, managing that part of the business, basically what I call the back end, is oftentimes overlooked. And nowadays there's enough software tooling and everything to help out, but it can still be quite a large part of the work. And when new managers start out, they tend to be focused for 95% on investing, which is good. But yeah, this part of the business is just there.
Right, totally. And now let's do the rapid fire round, wherein I'll ask you 5 quick questions about the investing you're doing, and you have to give 5 quick answers, right?
Okay. Yeah, sure.
Yeah. So the first one goes, what are the sectors and regions you invest in?
Regions, mainly Europe, US. Sectors, as I said, fintech. It's of course also for us all software, but it could be insurtech, legal tech, fintech, anything that we have a good understanding of.
Right. What's the typical stage of investment?
It can vary, because we set up SPVs for direct investing. So it could be, let's say, $1 million to a couple million. Again, we never lead round, so in the typical Series A, B will never be the largest part of a round, but along those lines. Yeah.
Right. And for VC firms, it's like Fund 3 or Fund 4, right?
Yeah.
Okay.
Yeah.
And what's the typical check size you put in for VC funds? You mentioned for founders.
Oh yeah, it varies, but it's along those lines as well. So we are not the type of investor that's doing like 10% of the fund or 5 or X. We do a couple million per fund.
Okay, that's awesome. And where can founders or managers apply for funding?
Just reach out to us. The website or LinkedIn usually works, or through the network. We're quite responsive and open to anybody could just reach out to us.
Awesome. Where can our listeners follow you?
LinkedIn is probably best.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Yaron, and for sharing your valuable insights on LP deployments at Pacenotes. Thank you.
Thank you for the invite, and thanks for having me.
Pleasure.